All right, guys, let's start. Okay, so now we have to do your Greeks, last chapter, right? Greeks. Very interesting chapter, difficult also. So let's start, guys. Mm, I hope you guys are practicing question, right? Please keep on practicing. Uh, Option sensitivity measures the Greeks. Fine. Uh, this is the last chapter of your syllabus, guys. But last does not mean that it is easy. Neither it means it's too hard. Neither it means it's not important. It just means that this is a chapter which is using a lot of concepts, right? A lot of concepts together, right? So basically, I told you, right? FRM part one, if you have to put it in one word, like if somebody asks you that what is the objective of studying FRM part one, right? Let's say somebody asks you, like, give me one word. If somebody says, give me one word, uh, why somebody should study FRM part one, you can say job, maybe better job, higher salary. But he says, no, I don't want to know better job, higher salary. I just want to know that, uh, give me one word, what academically your FRM one teaches you. What will be that word, guys? Anybody can tell me? I only want one word answer. One word answer, which FRM part one, risk, don't say risk management. Risk management is a very generic word. If I ask you one word that FRM part one teaches us, right? What will be that word, which you have seen multiple times in your syllabus, and which I also keep on repeating is the most important thing in FRM part. What will be that one word? Anyone? If you have to summarize, like let's say full syllabus, if you have to identify one word which kind of defines or is the essence of your FRM part one, right? Volatility, okay, fine. It's a good word, but not, I don't think that, yeah, that volatility is risk, right? I'm not denying that, but yes, but still not exactly what I'm wanting to hearing, right? Assumptions, no, not assumptions, no. Assumptions, okay, assumptions are good, important. So they're not wrong words. You are right. See, you are saying the right words. I'm not, but there is still a better word there, right? I'm not saying you guys are wrong. I'm saying you are right, but there's still a better word which defines whole FRM part one in one word, right? The whole FRM part one in one word, right? That is your options. No, not options. Hedging, guys, hedging. Hedging, right? Hedging is the word. I have told many times, right? Protect against risk is not one word, it's three words. But yes, but the point is hedging. If somebody asks you, let's say a doctor friend of yours asks you, tell me one word, right? Why are you reading these four books? Right? It is one word is hedging. FRM part one only is there to teach you hedging. Similarly, FRM part two also, I can tell you right now. FRM part two, if I have to define one word for FRM part two, that is correlations. Right? Because FRM part two is all about understanding that everything is correlated. That if the credit risk increases, it affects market risk also, operational risk also. The market risk increases, affect credit risk also. So FRM part two is all about understanding how one risk moves, the other affected, right? So FRM part 2 is all about understanding how one risk is related to other. Similarly, FRM 1 is all about understanding hedging. I've told you many times that one of the ways to study FRM part 1 is, if you have the soft copies of your Schwezer books or anything, then just do Control F and search for hedging word. And whichever learning objectives have hedging word, please read it multiple times, because that is the essence of FRM part, mitigation of risk, hedging. And the whole objective of studying is risk management. In risk management, we are basically looking at how to manage risk, mitigation of risk, right? So if you remember book 1, right, there are 4 steps which we could have done for risk, right? Accept the risk, avoid the risk, mitigate the risk, transfer the risk. There are 4 steps, na, book 1. So accept means you're saying that, oh, fine, small risk, let me accept it. Avoid means, no, this is too much of a risk. My business is not ready to take it, right? So you avoid the risk. Generally, accept and avoid are very drastic measures. Very few people are there. Very few people are there that, okay, small risk, let's keep it. Those kind of small risks generally don't affect the business, because they don't, since risk is small, reward is also small, so nothing much changes there. Avoid the risk means you're totally avoiding the risk. So that is also not a good opinion, because, or not a good option, because then you're not making money. Rather, you are being a very conservative approach. Mostly it boils down to mitigation of risk and transfer the risk. Transfer the risk is from credit default swaps. Credit default swaps are one of the reasons how you can transfer the risk, which are like, and that's why in book 1 you have chapter of credit default risk, credit default swaps, which is about transferring the risk. In book number 2, you have a chapter, book number 2 is quantitative analysis. Book number 3, there is a chapter called insurance, which again is like transferring the risk. Book number 3, there is a chapter called swaps, where you learn interest rate swap, credit default swap. Again, we are learning swapping the risk, right? And that's transferring the risk. But major thing is mitigation of risk, and mitigation of risk is hedging of risk. Hedging of risk is the main essence of FRM part 1. If you see from book 1 itself, you're always learning, how do I hedge it? How do I hedge it? How do I mitigate? Every chapter which you have studied, right? If you see book number 3, everywhere you studied, right? Oh, there is a counterparty. How do I hedge that risk? If it is forward futures, why I'm using it? Hedging the risk. If your option, why I'm using hedging the risk? Right? If I am studying any chapter, right? Equity, etc. Everywhere I'm learning hedging. Commodity chapters, hedge ratio, right? In your duration is also interest rate risk. Why did we learn duration? Hedging the interest rate risk. Why did we learn convexity? Hedging the interest rate risk. So the basic essence of FRM part 1, because this is the last chapter of your syllabus, right? So if you see, you are students, you are reading for the first time. I am teaching for 20th time or 30th time your syllabus, right? So my perspective is very different and your perspective is different, right? You are seeing it for the first time, so maybe you're not able to view it as I view it. When I see it now, once I have seen everything, FRM part 1, part 2, everything, CQF, CFA, all these things, then if I have to define like some subjects, if somebody asks me, why do we learn CFA? I will say, why do we do CFA 1? I will say CFA 1 is all about broader concept of portfolio management, right? It's a broad, like a bird's eye view of portfolio management. Why do we learn CFA level 2? I'll say CFA level 2 we do because CFA level 2 is like to deep dive, especially into equity valuations, financial statements, and fixed income, right? These are 2-3 main topics where we deep dive in CFA level 2. Then somebody say, what do you CFA level 3? I'll say CFA level 3 is more about integrating behavioral analysis, private wealth, portfolio management, technical analysis, alternative investments. It's a holistic investment policy statement you have to make. So that's a portfolio construction approach. So I can now, when I have done all these examinations, I can zoom out and say, right, what each exam does. When you ask me what FRM1 does, FRM1 does hedging, right? FRM main focus is risk management. FRM main focus is risk management. FRM1 is mostly focused on mitigation of risk. That is about hedging. And they also focus on your transfer of risk, which is credit default swap, interest rate swap, other kind of swaps, insurance, and generally basics, right? FRM part 2 is the main motive of FRM part 2 is to make you understand that risks are not in isolation. Risks work together in different environments. So never ever think that if a credit risk is happening, that's not affecting the market risk. No, credit risk is affecting market risk also. And market risk is affecting credit risk also, right? So all things are interrelated. That's why it's so difficult to become master in your risk management, right? So just to give you an essence, right? Just to give you a picture, right? And then somebody asked me, what did you learn in CQF? And I'll say, CQF was a very different kind of topic because I did CFA, FRM. CFA was totally about portfolio management and everything. FRM was about risk management. CQF gave me mathematical approaches to these two things. CQF is not a new topic. CQF, quantitative finance is not a new thing. Quantitative finance is just like a new tools for the same topic, right? In CQF, I did not learn anything about portfolio management. I learned about how to apply stochastic calculus in investment management, how to apply stochastic calculus in risk management, right? In CQF, I just got the tools to see investment management in a better way and risk management in a better way, right? CQF did not teach me any new subject, but gave me mathematical tools to relearn or learn better the previous subjects, right? So that's what the essence, right? So I'm just giving you the essence of the whole study. So now coming back to this chapter, right? So this is the last chapter. I just want to give you a clear-cut objective, right? This last chapter is about same thing, right? This is about that you are culminating your syllabus, last chapter of your book number 4. So it is like that we talked about so much of, hedging, etc. Now we are like saying that in your, especially in your equity markets, right? In the share market and the stock market, right? How do we hedge the positions? How do we hedge the equity positions, your derivative position, right? And what is a mathematical approach, right? What is the mathematical approach? How do we go about it, right? So that's the essence, right? So that's what we are trying to learn, right? So Greeks are tools. Greeks are tools which helps us, right? Greeks are tools which helps us in hedging your portfolios, especially in the equity world, especially in the derivative world. In your fixed income world, we have duration, we have convexity, we have those portfolio like key rates, right? We have barbell portfolio, bullet portfolio, those kind of things. In your equity world, we have Greeks, right? So Greeks we have. Now, another question which comes here is that in your syllabus right now, you will learn generally 4 or 5 types of Greek, right? You will learn about one Greek called delta, one is theta, one is gamma, one is vega, rho. So you will learn only 5 Greeks. Now, the biggest misconception which students take away from here is that there are only 5 Greeks in the world. No, there are many more Greeks also. You are focusing, or your syllabus is talking about, the whole FRM is only talking about 5 Greeks. But there are many more Greeks, right? If you want to learn, in fact, I have only written one article. I can show you one article, right? If I go here and search for it, my article only is a publish on a website here, right? I think 2 years back, an article I have written on. No, there was the article, yeah. Beyond Delta Advanced Greek Analytic. What I want to show you is, are you able to see? Yeah, you're able to see. So what I want to tell you is that Greeks are not only 5, right? In your syllabus in FRM, Greeks are 5. But if you see the Greeks entirety, Greeks are not 5. You are only learning delta, vega, theta, rho, and gamma, right? You have 4 this sea green color and one below which is like a what, purple color, right? One. But other than that, there are many other Greeks: vana, voma, charm, veta, vera, color, zoma, speed, and even gamma, which you are reading. Gamma, you will read only one kind of definition here. Gamma is a Greek which has another definition also, which will not lead in your syllabus. There is another definition of gamma, which is comes from zoma and color, right? So again, see, I don't want to go that deep, but objective of telling you all this is because just want to make sure that you know that the world of Greeks is much, much bigger. What you are learning is a small part of it. You are learning only first order Greeks, which are green, sea green color, and one second order Greek, which is gamma. But there are 5 more second order Greeks: vana, voma, charm, veta, vera, 5 more. And then there are 3 third order Greeks also: zoma, color, and speed. Okay, so this world is quite a big world, and yeah, just keep that in mind, right? So Let's go back. That was the introduction which I want to build before we even start, right? So now you're gonna know the essence, right? So whole chapter is about hedging. Objective is to learn how to hedge your equity portfolios, your futures and option positions, your derivatives, right? It's so much of volatility, right? Friday evening, the news comes out in Wall Street Journal. Not Friday evening, Friday morning, the news comes out in Wall Street Journal that Trump is thinking of attacking Middle East in a big way, and it has been told to evacuate Middle East, etc., for American citizens. Sunday morning, when I wake up, I read the news that Trump has kind of said that he's giving another chance for deal, etc. Right? But there's so much of volatility, right? You never know where the markets will turn on Monday morning, right? Monday morning, the markets will go up. Most probably now, markets will be stabilized and will go up. But you never know what will happen on Tuesday, right? Because this on and off is going on for almost 5 months, right? So and Iran has not said anything, right? Even Trump has said that I have given another chance. There is no statement from Iran's side, right? That what they want to do and what's their objective and what's the thing. So deal is happening, not happening, you don't know. So there's a lot of volatility in the market. It's a lot of things going around. There is something, I don't know how many people read it, right? There was a hedge fund which blew up, right? Situational awareness hedge fund, which kind of blew up, right? Did anybody read situational awareness hedge fund blew up? Anybody read like there was a hedge fund which blew up this week? Situational awareness. If you're not read it, go and Google it. Situational awareness, that hedge fund blew up, and Ken Griffin kind of saved it, right? So a lot of interesting things are happening, right? There's a lot of volatility, right? So that brings out that risk management is very important, and that's what we'll study here, right? So, okay, let's start, guys. Enough of introduction. In fact, quite a lengthy one. Okay, now we are talking about naked and covered position. Naked means you are basically without any clothes, right? And without any clothes means that without any risk management in place, right? So what are the risks in positions which are without any risk management, and covered means which are covered by risk management, and stop loss strategy, right? A little bit of hedging kind of thing going on here, right? So this is naked positions, risk in naked positions. Naked call position. Naked call position means you have bought a lot of call option or you have sold a call option. Naked call position occurs when a party sells a call option without owning the underlying asset. Means you sold huge amount of call options without owning the underlying asset. Now, the biggest risk for the call option selling is that if the market moves up, right? So the potential loss is unlimited, right? Because if you remember the graphs, this is selling of a call option. You remember the graph of selling. When you sell an option, your loss is unlimited, na? When you sell a call option, what is your kind of buyer of a call option was like this, na? Buyer of a call option was like this. Seller of the call option is like this, na? Mirror image, right? So loss is unlimited. As if the stock price can rise without bound, right? So if the stock price keep on increasing, loss will keep on going down, right? This is I taught you in a lot of detail, so I don't need to repeat here. In fact, I have taken extra classes here. You remember this? Selling of call option, remember this graph? Yes, no? You remember, no? I taught it in a lot of detail. If you don't remember, go back and see the notes, right? So maximum gain is obviously seller of call option capped at the premium received. This is the maximum thing, right? Selling 10,000 call option at 23 strike price for a $4 premium. You'll only earn the $4 premium on a stock trading at 20, right? Revenue is 40,000, right? So 10,000 into 4. If the stock expires at 30, the loss is 70,000. You can calculate this, guys. I'm not repeating it here only because even if I repeat, students who have not studied it will never get it, right? And students who have studied will easily get it without me telling, right? Because this is a topic which is can't be studied in isolation, right? This particular example has to be understood with a lot of other derivative examples. So I've taught it. I can just give you a small example here that stock is trading at 20, right? If stock goes, let's say to 30, means stock has increased by $10, right? And if you remember the graph which I had made, this used to be your X, right? So this is 20. Premium is 4, so this will be X plus P, right? X plus P. So this will be your 24. And if the thing has gone to 30, thing has gone to 30, means stock price has gone here. So means this is the loss which is happening for you, right? The graph is like this. So you are going in the loss territory. How do you calculate this? You can go and back and revise the derivative. You'll find out, right? Can't cover it, right? There's no use. I hope you know how to calculate it, everyone. Covered call position occurs when the party selling a call option owns the underlying asset. Here, the idea is that you're owning the underlying asset. So if you own the underlying asset, that's a good part. No? Even though you might lose on the derivative position, but your asset you are already holding, that will gain, right? You minimize the cost of short position by locking in revenue from the option side. You have two positions, right? See, this is a covered call. This is covered call, right? Covered call was one of the trading strategies. Yes or no? There I made chart, right? Three charts, right? One was spreads, one was synthetics, one was combination, right? All this I have taught it. This comes in under synthetics, covered call, protective put, and there was one more, which was that, which one? That was that PP and PP is something, no? So that one. Third part was what? I forgot. PPN, right? Yeah. Okay. So yeah, so you guys remember it, right? So go back. This is covered call strategy, already covered in derivatives. If somebody doesn't know, it means you are not revised, right? So go back and see that. Uh, Potential loss if the stock falls significantly. The loss on the long stock position can be substantially larger than the premium received. That can happen. So all this thing is a covered call strategy, already covered in trading strategies, right? This is already covered. It's kind of repetition. This covered in trading strategy, chapter number 15 of your book number 3. We spent a lot and lot of time there, right? That's why I'm saying, and this is naked call position. This is only one position that side, right? So go back and revise it, guys. That's it will be a good revision for you guys. Then we get into this is covered call. I have written also. Long position stock, short position call. Stock goes up, long position profit, short is in loss. Balance it. When stock goes down, long position loss, short position goes up, again a balance it. So I've written everything here. You can understand. This is a question we have. Investor takes a short position in a call option on ABC. We sold a call option with a current price of 15, strike price of 18. If the investor does not own the underlying stock, the biggest risk to the investor is if you're not owning the thing, the biggest risk is what? Biggest risk is stock going up, right? Yes or no? If you don't own the underlying, the biggest risk is stock going up, right? So it's a very simple kind of thing. Be selling a call, the stock price is rising above 18, right? So stock going up is the issue. If it crosses the strike price, that's the issue. Anybody finding it difficult to understand? Again, I'm repeating. There might be some student who might have missed class. There might be some student who is new here. If you are not able to understand this thing, it's not that, I am teaching bad or something wrong is happening. It's just that this is a very detailed topic. If I start teaching it right now, this whole topic will become extra 1 hour, 1.5 hours. I don't want to go that side because this has been covered absolutely in extreme depth, right? In your trading strategies chapter, in your option chapter, which I have taken in live classes. Students have attended, students have understood, right? So I have spent double the time there to explain these concepts, right? So if you are struggling here, if you are saying that, sir, I don't remember anything now, can you repeat for me? I don't mind repeating, but that will be not so useful. The only reason is that it's not a small topic. It's a big topic where a lot of things are moving around, right? So the best way to learn is, if you're struggling, go back and learn trading strategies. You just pick up trading strategy. There's a strategy there called covered call strategy, right? In the synthetics, which I have written, right? There, read that strategy covered call. All concepts will be clear. Right? All concepts will be clear. Okay. So just focus there. This is easy. Then this is stop loss strategy. This is designed to limit losses associated with the short options call writer. So the idea is that if the stock is going up, what do you do? So this is one of the things. It requires purchasing the underlying asset for a naked call position when the asset above rise of the stock price, right? Basically, idea is that let's say the stock started rising, right? Then what do? You purchase the underlying asset for a naked call position when the asset rises above the option strike price. Let's say it crosses the strike price, you start purchasing that. The asset is then sold when it falls below the strike price, right? Objective is to maintain a naked position when the option is out of money and a covered position when it is in the money. So it's a very dynamic kind of strategy. Till the time you are below the strike price, you don't do anything. As soon as you go above the strike price, you start buying the call option, right? So it's a very tricky kind of strategy, right? I hope you are getting my point. This is not a very, like, to be fair, not many people do it, or even if they do it, this is how algos do it. This is algorithmic strategy. This is not a manual strategy. The point here is that, let's say the previous example we are saying, now the stock is currently trading at $15, right? And strike price is 18. So what we are saying is that don't do anything till the time stock is below 80. But simple point is we are following this graph. This is 15. This is seller graph, right? This is 18. We are saying that till the time it is below 18, we are safe. So don't do anything. As soon as it start crossing 18, as soon as it goes above this part, it start going this side, right? And loss starts increasing. Best option is start buying call option, because that buying call option will give you profit, which will give you this profit, which will cancel this one loss, right? So the point here is till the time your stock is below 18, the strike price, don't do anything. As soon as start going up over 18, you start buying call option, right? Which is not easy to do manually. It has to be done. What do you say? In a in a different way, right? So that's the idea. Advantages tends to work well when an option is initially in the money, right? Same thing. So, but disadvantages, transaction cost can become higher due to frequent buying, because stock price will not go in one direction. Let's say it went to 19, you bought a call option, and then before you even think, in a blink of eye, it moved to 17. What can you do? Right? Suddenly the bought call option is in loss. So you cannot sell and buy so easily, right? So this creates a lot of problem in this stop loss strategy, because you're saying that if cross 18, you buy the call option. If you come below 18, you sell it, right? So you have to frequently buy, frequently sell. The stock can move now. 18.5, 17.5, 19, 17, right? Up, down, up, down. So as soon as crossing 18, you're buying it. Coming below 18, you're selling it. Again, above 18, you're buying it. Below 18, selling. So it's a continuous buy and sell, which is a very irritating kind of thing. On the expiry price. Price uncertainty about whether asset will be above or below the strike price expiration. You don't know, right? What will happen, right? So this causes a very dilemma kind of thing, right? So that's the problem, right? Okay. Stop loss strategies with call option require purchasing the underlying asset for what? Tell me, guys. Stop loss strategy is for naked call position. No, stop loss strategy is not for naked call position. No? Stop loss strategy is for covered call, right? Okay, sorry. Stop loss strategy is with short option, naked only, right? Naked only. Purchasing, it's a naked call option position only. For a naked call position only. When the asset rises above the B, it should be B, right? Yeah, it's for naked call only if you need it. It's for naked position only. Stop loss strategy is for naked position only, right? When it crosses the kind of what do you say, the strike price. So not difficult at all, guys. Only thing is, if you don't understand derivative, you don't understand trading strategy, then it is difficult. Fine. Then we go to delta and delta hedging. Now we are getting into the meat of the topic, right? Delta, what is the option delta? What's the forward delta? What is the future delta? What is dynamic aspects of delta hedging? What is about maintaining the hedging? Other portfolio hedging approaches, right? So that's what we need to understand. Now, delta. What is delta? Delta is a Greek, right? I showed you in the image, right? Delta, now we have to learn the definition of delta, right? Delta is nothing but this formula. Formula looks very tricky, but you can see delta is nothing but change in the option price. It can be anything, guys. Here we have given call option C, but it can be anything. Change in option price divided by change in underlying, which is stock price. It can be call option also. It can be put option also. Delta is a Greek, which is a sensitivity. It can be for call also. It can be put also. Here I have written call option. I can write put option also. Put option is change in P, put option, for change in underlying, which is your stock, right? The ratio of change in price of an option to change in price of underlying asset, that's delta. Change in call, you can do put also, change in stock price. Interpretation represents the slope of the call option, represent the call slope of the call option pricing function at the current stock price. Range of value call option, please remember these things, guys. Very, very important. Call option delta is between 0 to +1, right? There is a graph also given in book. You don't need to go too much into that. But remember, call option, see, this topic is very deep, right? But as I told you, right, if anybody is thinking, sir, I want to become master in this topic, then you see there is, there's so much to learn, right? There's so much to learn, right? So many things to learn. Okay. In fact, I will tell you guys that you should actually remember this table, right? In fact, let me put it. I think I would have put it in that place, but I will say that this is actually important for your exam, right? It is important for exam. I'm putting it right now here only, right? So this is an important table for your exam. Uh, Ignore the third order Greeks. Ignore the third order Greeks. Right. So you can ignore this part. You can ignore this part. This is very high level. So ignore this. Ignore. Ignore VAM. This is also not part of your syllabus. Vana is also not part of it. Charm is also not part. This is second order Greek, guys. This is some typo. This is second order Greek. Right. You have to remember delta. You have to remember Vega. You have to remember theta. You have to remember rho. You have to remember gamma. And the whole line you have to remember. What is the value of delta in the money, delta at the money, delta out of money, implications. You have to remember these 5 lines. You have to remember, right? A lot of questions you can solve in exam if you just remember these 5 lines, right? So these 5 lines are actually important, right? Just keep that in mind. This will help you to score marks in exam easily. Okay. So my point here is, and ignore this gamma, speed, this whole paragraph, color, ultima, beta, vera. All this is not part of FRM, not in FRM part 2 also. But objective of showing you this is that don't be in a wrong notion that we have covered everything in Greeks. No, we have covered only the basic version of Greeks in FRM. There's a full version of Greeks which is still pending, right? That's the idea. Okay. What does the slope of the call option mean? Is it change in stock to the change in delta? See, slope of call option is change in your, slope of a function, right? Slope of a function is what? Slope, when I say slope, right? Slope of something, where it is given, slope generally gives the next derivative. Where is it given slope of a call option? Not given here, no? Where is it given? No. Where is written slope of a call option? Previous slide, right? Okay. Slope is basically diagrammatic way of saying, right? So ratio of change, okay. Interpretation, okay. So interpretation is represent the slope of call option, right? Basically change in the option price for change in stock price, right? Slope of call option is what, right? See, slope is what? Slope in your school days when you learned about slope, when there was a line, let's say this was a line. So we said now slope of this line is what? Delta V change in your y-axis divided by change in x. That's how we found the slope, na? So slope of something is change in, if this is y and this is x, right? So again, same thing. Delta is nothing but change. Change here I'm noting by this symbol. I should not do it to be fair, right? But just because this is how we write. Delta is nothing but change in the option price, change in stock price. So slope is nothing but change in y-axis divided by change in x-axis, right? Remember these values, right? Call option delta ranges from 0 to +1. Always remember call option delta is positive, 0 to 1. Put option delta is negative, -1 to 0. Again, 0 and 1, like actually the value is from 0 to 1 only. But why the symbol is different? Because when the stock price goes up, call option goes up. So they are similar nature. So that's why delta is from 0 to 1. When the stock price goes up, put option goes down. So the relationship is opposite. That's why it is -1 to 0. Ultimately, it is 0 to 1 only, but one is 0 to +1 and one is 0 to -1 because the movement is opposite. Right? Example is very important. The call delta of 0.60 means the call option price will change by approximately $0.60 for a $1 change in the stock value. Makes sense, na? 0.6 is the delta, which is change in the option price divided by change in stock price, right? So if we are saying it that if I take it 1 here, so it means the change in the option price for $1 change in the stock price is 0.6, right? So it's a simple fair representation, just the explanation of the formula. And then there is something called delta neutral hedging. This is a very common phenomena. Again, hedging, I'm telling you, this is very important. This comes in exam also. See, delta neutral hedging means that people who are making their portfolios, this is a common strategy to hedge their portfolio, that make your portfolio delta neutral. Delta neutral means your delta should be 0. To completely hedge a long stock or a short call option, investor must purchase or short the number of shares of stock equal to delta times the number of options sold. This is called delta neutral. Delta neutral means you're making delta neutral, right? Now, for a short 1,000 call option, see, your position is you're sold 1,000 call option and your delta of one call option is 0.6. So means your sold call option means negative. Listen to me, it's very simple. It looks a very difficult topic, but it's a very simple kind of thing. Just look at me, right? Your sold a call option means negative delta. How much you have sold? Your one delta is 0.6. You have sold 1,000, right? So it means your delta is your -600. Delta is -600. Now, what is your objective? Make delta neutral. Delta neutral means you have to make delta 0. So -600 plus you have to add x, make it 0. So what will be x, guys? X will be 600. So I have to get something which has 600 positive delta. Now, I have a negative delta because of options, right? Now, you have studied with me. Generally, options are hedged with, if you remember your synthetics, options are generally hedged with your stocks. This was the easiest strategy which was covered in your covered call and protective put. So if your option is giving me -600, I need to get +600 from stocks, right? So that I get delta neutral, which is 0, right? So if I have to get +600 from stock, I must know the delta of a stock. Please remember, delta of a stock is always 1. Why delta of a stock is always 1? Because delta of stock will be what? Delta of stock, if you go by definition, will be what? It will be change in the stock price divided by change in the stock price. Am I right? Delta of stock will be what? Change in the stock price divided by stock price, right? It cancels, it becomes 1, right? So it means I have -600. I need to get some stock S into 1 is equal to 100. Now you tell me what will the stock? Obviously, S is 600. Na? So it means the investor needs to be long 600 shares of the underlying. Please understand the example which is given here is very basic kind of example. And we have taken the most simplest of position for FRM part 1 just for students to understand. But this can become very, very complex. Let's say we take spreads. Here I have taken a very simple example, stocks only, right? And the book also talks about stock only. But let's say you're hedging option with option. Let's say you are hedging call option with put option, and you have to do so much of calculation, right? So idea here is just to illustrate the example that one of the easiest example is covered call, etc., where we are saying that earlier we were saying covered call is, see, objective of telling this option delta is very simple. Listen to me carefully, right? If you see the chapter, how it started. Chapter we started that, oh, like you see how the chapter is building up. First, we told that, oh, naked positions are very bad. People lose a lot of money. You should have covered positions, etc., etc. Naked positions, you potential loss is unlimited. Covered position, you can cover up. So we are building the chapter that naked is bad, covered should be there. But when we talked about covered, then we said that, okay, covered is there, but covered, the stop loss is not very clear, right? We cannot define stop loss because this is a very irritating strategy. When it goes above 18, you buy the call option. When it goes below 18, you sell the call option. So you realize that this is such a time consuming and algorithmic strategy and such a wastage of time that whenever it goes up, you buy. Whenever it goes, so it's like it keeps you busy, right? You don't want that thing to happen. So can we have an efficient way to do it? Then we realize that, oh, efficient way to do it. There is something called Greeks. Greeks are something which tells us sensitivity. There we learned about the delta Greek, which gives us delta change in PC about change in S, change in P divided by change in S, right? Call option 0 to 1, put option -1 to 0. Then we learned there is a delta neutral hedging. So ultimately, we are still talking the same thing. That how do we hedge? How do we hedge? How do we hedge? First, we learned that, okay, naked call hedging, not possible. Covered call hedging, good. Covered call hedging, stop loss strategy, very irritating kind of thing, very manual kind of work. Do we want to do it that way? Now we are learning, no. We can have a different kind of strategy, which is delta neutral strategy, delta neutral hedging, where we have to make sure that delta has to be 0, right? And here we are saying that if we take the call option we have sold. Sold means negative, right? If it would have been bought, I would have said positive. Sold means negative. 0.6 the delta multiplied by 1000 option minus 600 delta. I know the simplest example is covered call, where I am hedging a stock position with I am hedging an option position with a stock position. So I'm taking minus 600 plus X. X means a stock delta. Delta is 1 because change in stock divided by change in stock, which makes it 1. So S into 1 is 0. So I find the S value, which is 100, right? So again, this is the most simplest interpretation, most simplest way of hedging. But don't get it wrong in your mind that this is the way the world operates, right? You are being taught ABCD of hedging. This is ABCD of hedging, guys. This is literally ABCD of hedging. This is literally class 1 of hedging, right? Professional don't work like this, right? This is class 1 of hedging, right? That you are doing like this. You have seen how many trading strategies we have. So here I am taking like a stock in simple way. But if you go and deeper, then you realize that hedging has to be done in a very, very difficult manner, right? And that's the whole idea of hedging, right? So, and Black-Scholes-Merton model, delta can also be calculated as the ND1 in the Black-Scholes option pricing model. Remember this part? ND1, which you get in your Black-Scholes model. ND1, you remember, na? ND1 we studied yesterday. ND1 is also called your delta. ND1 is also called the delta of call option, right? Delta is also called the delta of the call option, the Black-Scholes-Merton model, right? So please understand, this is a surface level analysis of hedging. Simple examples are being taken. Simple things are being considered. Simple formulas are being considered. Simple direct words are being given. Nobody's telling you why ND1 is called the delta of the call option, because it's a very, very deep subject, right? This is the last chapter of your book. The very, very deep topic. Objective is just to make you realize that, okay, there is something called delta neutral hedging, etc. But that will be understood later, right? So that's the whole idea. Okay. There's some questions here. Sir, this is used in SCCR delta adjustment of option. Yeah, SCCR standardized, but that's a standardized, na? Delta adjustment of option, right? So that's the idea, right? Standardized approach for CCR, right? But again, it might be used for CCR. I'm not denying that, right? But what I'm trying to say is that professional investors who kind of use this for hedging of their equity portfolio, etc., right? Their things are not done in so simple way, right? You go into, and it will come ahead, right? They will come as delta gamma neutral hedging, right? And you have to consider a lot of other Greeks. And I'm talking mostly, see, SACCR is a standardized approach. Standardized approach is a simple approach, right? I told you earlier also when we were discussing, right? There are two approaches. One is internal model approach, one is a standardized approach. Standardized approach is a less sophisticated approach. Standardized approach is approach for small banks, which is given that, okay, you don't want to go and do sophisticated things. You take the simple approach, what we are taking. So standardized approach is generally a simple approach. If you go into your internal model approach, right, that's a complicated approach, right? So that's what I'm saying, right? It might be part of SSCCR, but it's a simple, right? Anything which is given a standardized approach, SA approach, is generally a simple thing. The more complex things are in your internal model approach. Okay, so remember that point. Fine. So this is what you have to remember. Again, we'll come on it, but please remember the values of ITM -1 for calls, -1 for put, ATM 0.5, OTM it is almost 0. It gives a directional exposure, highest rating. Where it is highest, please remember it, right? Wherever it is highest, please try to remember it, right? So please read this, guys. So please read this kind of directional. This is all very important, guys. It will come ahead. They're all questions. They ask you, delta is highest where? Delta is highest at the ITM. Vega is highest where? Vega will do what is Vega theta rho head, but I'm just telling you, you have to remember this. Where is Vega? ATM option most sensitive to Vega, maximum here, right? Theta is highest where? ATM, right? Rho is highest where? Highest at the ITM, right? Rho is highest for the ITM. Gamma is highest, right? So if you see, to be fair, how do I remember for exam is most of these things out of five, three are highest at the ATM. Three are highest at the ATM. Only delta and rho are highest in the ITM, right? So first of all, this is a very typical exam question. Typical exam question. Three things highest at ATM, two things highest at ITM, right? So don't forget that. And also this part. We'll see it ahead. Let's go ahead, okay? That's what we do. This delta is this, call is +1 to 0, put is -1 to 0, ITM call +1, ATM 0.5, OTM 0, ITM -1, ATM 0.5. This, please remember, ATM is same for both. Call and put, ATM is same. At the money is same value. If you don't know ATM, ITM, you have to go back and see the derivative chapter. There's no way you can solve it, right? ITM call is +1, put ITM is -1, right? OTM is both 0. Plus, please remember, OTM for call is different, OTM for put is different. If you remember my chart, which I used to tell you, right? This is ITM for call, right? This is ITM for put. This is OTM for put. This is OTM for call. I don't know how many people remember this chart, which when I taught you, right? So you have to remember all these things, right? Go back and revise it, guys. Same thing, I have built it here. ITM, ATM, etc. Example given. Everything has been taught in a lot of detail in derivative chapters. I don't want to repeat it, but go and see those chapters if you want to understand. This is what I was telling you that, if you are seeing it for the first time, you might think that this is the whole world, right? Delta, Vega, Theta, Rho, and Gamma. But this is not the whole world, right? It's Vana, Voma, Cham, Beta, Vera, speed, Zoma, color, right? So there is a lot of things. Gamma is the second order derivative. Gamma basically means, if you see the graph, gamma basically means that it is change. And if actually this graph is actually very good, right? If you look at this graph is actually very good. What is happening here? Price in below price is given delta. It means change in call option per change in price, right? It is given in below volatility, which means change. Vega is what? Change in volatility, change in option price for change in volatility, right? Similarly, theta is given below time to maturity. Change in option price to change in time. Interest rate is change in option price to change in your risk-free rate. So I have written everything here. See, time to maturity, theta, TT. Change in option price by delta T. Price means stock price, S. Change in call by change in S. Strike, there is nothing important strike. Volatility, change in option price, but change in V, volatility. Right? So these you have to remember. And one second order Greek. What is gamma? Gamma is coming from delta. Gamma is telling you change in delta or change in stock price. So change in delta. Delta itself is change in C, na? So it becomes double derivative. Gamma is the only one which is double derivative in your syllabus, right? Otherwise, all other are first order Greeks, right? So delta, Vega, theta, rho are first order Greeks. Gamma is second order Greeks because gamma is change in delta. And change in delta itself is change in price, right? So this is change in call option price square, right? So del square ski by del S square, right? So that is the double differentiation, right? Again, this is just to make you understand, right? This is what I have given here is don't bother about not in FRM part 1, extra knowledge, very important for exam, tick mark, remember very maximum, etc. Everything is given here, right? I've already explained, right? This is the graphs I have made that will help you understand. See this, OTM to ITM, delta of call goes from 0 to 1. Delta of put goes from -1 to 0, is -1 below, 0 above, right? Uh, how do you see ITM, ATM? You have to remember all these properties because the questions are on the properties only. Call option delta I1 for ITM, put option delta -1 for ITM, ATM call delta 0.5, ATM put delta -0.5, OTM call delta 0 and 0, right? Or minor negative also you can say, right? So remember these properties. These are the question of the exam here, right? Again, delta neutral hedging, same thing I have said, right? Hedging, delta neutral hedging is 0. There is something called gamma neutral hedging also, which will be given ahead. Simple idea is if you are shorting something, you're selling something, it is negative, right? Please understand. Somebody says short call. Somebody says short call. Short means negative. Call has positive delta. So negative plus positive, negative into positive, you multiply, it becomes a negative. So total delta is negative. That's why I had -600. Let's say I give you long put. Long has a positive sign. Wherever you find long, that's a positive sign. Put has negative delta. Let's say I give you short put. What will the delta? What will be the sign for short put, guys? Tell me. Short put will be what will the sign? Short put what will the sign? No, why short put negative? Short is negative. Put is what? Short is negative. Put is what? Put is also negative, na? So negative into negative is what? Positive. Please understand this, right? Please understand this. How you have to solve, how you have to get the sign. It is short call options, right? Short call option. Short is negative, call is positive. Short has negative sign, long has positive sign. Call has positive sign, put has negative sign. When I'm you joining two things, short and call. Short negative, call positive, negative into positive becomes negative. If I say short put, negative into negative becomes positive. If I saying long call, positive plus positive becomes positive, right? If I say, okay, these are the three options which are possible, right? So covered call was what? Long stock and short call. Short call was negative. Negative thing, delta of a stock was what? Delta S by del S is equal to 1. So -600 plus positive number 0, -600 into X into 1 or N into 1, N is equal to 600, right? So depending on your existing position, you will decide what action you need to do. Everything is written here crystal clear. The objective to do this exercise here is to tell you that when you are doing delta neutral hedging, you have to make sure that you understand the existing position. Your existing position was short call option. Short is negative, call is positive. Short, when you're negative thing, simple point. Yeah, you take negative and call is positive, you multiply it, you get a negative value, right? So again, remember this thing, right? I have given you much more elaborate thing, which is not even given in your book, so that you can solve the questions easily. It's the same thing which I did when I was teaching you derivative, because this is the subject which I am expert in, right? So this is, I've given everything here, right? If a short call, negative into positive, negative, long call, negative into negative, negative plus positive, 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 right? So final sign decided here, right? So please remember these things, how come up, everything is made in your notes. Delta of call option, ND1, delta of put option, minus N minus D1. N minus D1 can be written as 1 minus ND1, right? Minus, that becomes ND1 minus 1, right? So delta put option is ND1 minus 1. This comes in exam. They tell you find out the delta put option, that is ND1. Sometimes they give you this. Sometimes they give you this minus N minus ND1. Sometimes they give you ND1 minus 1. Both are correct answers. Please understand. If they give you minus N minus D1, that is also correct. If they give you ND1 minus 1, that is also correct. Right? Don't make it wrong. D1, you know, we studied yesterday. Call option delta ND1. Put option delta, it can be minus N minus D1 or minus 1 minus ND1 or ND1 minus 1. Whatever form it is given, just remember it. They will ask you a question here. You have to you could please share us technical insights, Greeks of the option minus sheet. Which is the sheet? Which is the sheet? Technical which is the sheet you are asking? Technical insight, Greek cross option minus. Which is the sheet? I don't have the sheet. Which is the sheet you're asking? Where is the sheet? I'm not sure. Technical insight, Greek across option minus. I don't have this sheet, right? Maybe this is somewhere else. I can like you can see it, right? That's the point. All this is given here. I've explained you delta of call option, how it moves. Call put, I have put it there. So this is now see here. Let's do the question. Which of the following choices will effectively hedge a short call position that exhibits a delta of 0.5? Right. So which of the following choices will effectively hedge a short call position? Short call means now you understand, right? Short is negative, call is positive, overall it is negative, right? So you are getting negative delta, right? So negative 0.5 delta. It has to be hedged with a long position, right? So if you sell 2 shares, you're not hedging it because ultimately objective is to get zero, na? Zero can only be get if this is a positive number, right? Positive number means can you sell it? Sell with a negative number. You can't do it. Sell the number of shares on the line equal to half the option sold. Sell will never work here, right? You have to buy 2 shares on the underlying or buy the number of shares on the underlying equal to half the option sold. Now this is what we are thinking. Buy 2 shares of the underlying for each option sold, right? Or buy the number of shares of the underlying equal to the half the option sold. What is the answer, guys, here? What do you think? Right? D is the answer, right? Because it is half, right? You have to see half, right? It's an easy question if you understand the logic, right? Because you have to have positive thing, right? Go back and revise it, guys. Again, if you're finding it too difficult, because this is a little advanced topic, but you have to align with the what you say understanding of derivative, right? Now, delta of a forward position. Delta of a forward position is equal to 1. Remember this part. Delta of a stock is also 1. Implies a one-to-one relationship between the value of the forward contract and underlying asset. Easily hedged with an offset underlying asset position with the same number of security. Adjusted for dividend, please understand the delta for where you have dividend is exponential minus QT into 1. Futures delta, generally not 1 due to the stock futures parity relationship. For non-dividend paying stockholder, delta is exponential RT, where R is the risk-free rate and T is the time to maturity. For asset with dividend, it is exponential R minus Q. So remember this, for forward, it is 1. Dividend paying, it is E minus QT into 1. For future is exponential RT. For dividend yield, exponential R minus Q into 2. Short future position hedged by going long the derivative assets, which makes sense, right? Short has to be hedged by long. Okay. Then let's do this question. If the risk-free rate is 3%, the time to maturity is 9 months. The delta of a forward position, right? Delta of a forward position was what, guys? You don't even have to solve the numerical. What was delta of forward position? Delta of forward position was 1, right? Perfect, right? You don't need to actually, it's just to confuse you, right? It's a 1. Right. Then we get into this part is important. Now we are getting into hedging part, right? How do we hedge? So delta we understood, delta as a function of your stock price. The delta of an option changes as the underlying stock price changes. So stock price will never remain constant. Stock price can go up and down. So delta will keep changing up and down. Rebalancing, when delta changes, the portfolio is no longer hedged, requiring the investor to buy or sell the underlying asset continuously to maintain delta neutral position. Then the goal of delta neutral position, to combine an asset position with an option position such that the portfolio value remains unchanged by fluctuation in the asset value, right? So that is also very, very important, right? So point is very simple, right? Wherever the stock moves, right, you have to make sure that your combined position, right, remains zero, right? I combine an asset position with an option such that the portfolio value remains unchanged, right? Which means we are maintaining delta neutrality, which is delta zero. Creating a delta neutral position, that is what is being taught here for a stock of position. A risk-free combination can be a long stock and a short call, which you have seen, covered call, where the number of calls to short is given by 1 by delta C, right? So number of options needed. For example, let's see the example you learn more. Investor owning 60,000 shares of ABC stock. If somebody is owning 60,000 shares, right? Okay. With a call option, strike 50 delta 0.6, right? The idea is very simple that, see, the delta, somebody is owning 60,000 shares, right? His delta is what? His delta is positive 60,000 because stock has positive delta. His delta is positive 60. Now, what is our objective? We have to make delta neutral. If our existing delta is zero, I need a negative thing. If I need a negative thing, right? Negative thing will be short, right? I need to short and I need to short option, right? So if I need to short option, which can give me negative, short is negative, call is positive. This combination can make me negative, positive, negative. So I'll short call option. Short call option, and how many call option I need to short? That decision I have to make, that how many call option I need to short. So that will depend on how much delta of call option I have. If the delta of call option is 0.6, means 10,000, 100,000 call option into 0.6. I have to find 100,000 now. So the 100,000 I have to find out. So I know if I put it, I have 60,000 stock delta minus 0.6 call option delta into N is equal to 0. So I can calculate now 60,000, right, is equal to 0.6 by N. And then you find out N from here and you take it that side, right? Equal to 0.6 by N. N is taken, what did I do wrong? 60,000. 0.6 into N. It should be N by 0.6, right? No, it should be, what mistake I'm doing?
It should be 0.6 N into N.
Yeah, 0.6 N, sorry. I'm doing 0.6 N. 0.6 N, right? 0.6 N. Right? Yeah, 0.6 N. What am I doing? 0.6 N. Right, 0.6 N. N is equal to your 60,000 divided by 0.6, which makes it 100,000, right? So idea is very simple, right? Delta neutral is all about making the whole position zero, right? Whole position has to be made zero. You have 60,000 shares. Means 60,000 to 1, 60,000 delta. You have to make it zero. So you multiply with something or you add with something, it makes it zero. So you positive, when added with negative, will make it zero. Negative, you get it, easy way is short call, right? Short is negative, call is positive, which is negative, right? And you have 0.6 into N, right? And you have to find out. So it's not difficult at all. It's very simple. Either you can follow the tricky methods which are given here, or either you can follow my method, which is like simple first principle approach that I have to make it zero. That's straightforward, right? But practice it, guys. It doesn't strike you immediately, right? Maintaining the hedge, that's the point. You have to always maintain the hedge, limited effectiveness of delta neutral position. Basically, delta neutral position only holds for a very small changes. It's like duration. You can't help it much. It holds for very small things. When it's a massive change, then gamma comes into picture. Frequent rebalancing dynamic hedging has to be done. Must be frequently or continuously rebalanced to maintain the hedge because the option delta changes, underlying stock price changes, and stock price never remains constant. Costly process, continuously maintaining a delta neutral position can be very costly due to transaction cost, right, or selling additional contracts. Dynamic or static hedging, adjusting hedge on a frequent basis. Static hedging is like static, setting up daily hedging initially and never adjusting it. Static hedging is of no use, to be fair. Rebalancing in the stock price, let's move from 50 to 51. Stock price is changed by $1. The call option delta changes from 0.6 to 0.62. Stock price also moved. That moved your delta. Investor need to adjust the number of short call position. If they initially shorted 100,000 options for 60,000 share, right now they have to change, because earlier they had done 60,000 by, earlier what we did, earlier we did 60,000 by 0.6. That gave me your, when I found N, 60,000 by 0.6, that gave me N. So N I found out 100,000, right? Now what is happening is that my 0.6 has changed. So 60,000 by 0.6 to 96,774. So my new requirement is 96,774. Old thing was 100,000. So I have to change it, right? That means sell 32 contracts, right? Right? Sorry, it was short, na? It was short. I have to reduce. It was short. It was already sold. So sold has to be reduced. So I have to buy 32 contracts. Right? I have to buy 32 contracts because sold, I have sold 100,000. Now my new requirement, earlier I sold 100,000. Now I have to sell 96,774. So it means I have to change my initial position by, why it is 32? It should not be 32, right? It's 30. Why it is 32 given? Why it is 32? 96, why it is 32? Why it is 32? 96,774 doesn't make 32, right? What am I missing? Why is it 32 little? It is 300 short, 32. Need to short these many options. Do we have some, we might have a lot here, right? We have a lot size would have been there. 774, just divide 774. Sorry, not divide 774. Divide 200, 26. 226 by 32. Just divide 226 by 32, guys. What is it? Are we getting something? What is 226 by 32?
7.06.
7 point something. Why? How it is 32? I'm just guessing. Why they are taking 32? Why they are taking? Anybody making sense? Why it is 32? Or where is the 32 number coming from? See, 60,000 by 0.62 is okay. 96,774, right? But why? Meaning 32 option contracts need to purchase. Earlier, my option contract was 100,000 option, right? Now 96,7. So till here, answer is right, right? But why are they saying 32 option contracts and not able to get what is this? What is this option contract?
So it's a typo mistake. It should be 3,226.
Yeah, three something, right? 3,000.
226.
Yeah, that's what I'm thinking, right?
Submission would be 1 lakh.
Yeah, that's what I'm saying. What is 32, right? Typo mistake, right? So, yeah. So because 96,774, na? Yeah, till now it was right. So again, the idea is earlier when you divide 60,000 by 0.6, you got 100,000. Now you are 100,000 divided by 0.6 to 96,774. So I have to buy 3,226 more because my position has changed, right? That's what I'm thinking. 32 is what, right? So this is what the static hedge strategy will be least effective when the underlying asset stock price. Now, this is very interesting question. This question is very, very interesting, guys. Static hedging strategy will be least effective where? When the price moving from 4 to 6, 20, 21, 26 to 35, 35. So least effective here. Why least effective? Basically, static is least effective when there is a massive change. Now you would say, sir, massive change, everywhere it is happening. No, if you see change from 4 to 6 is like 50% change. So when there is a change of 50% in a stock price, then static hedging does not work properly. Here the change is small. It is 1 by 20. Next change is what? 1 by 25. It is 1 by 34. Here the changes are small, right? The massive change 50% is happening here, right? So static hedging is least effective here. You need to have dynamic hedging here. This is a very interesting question. Very, very interesting question, right? Other portfolio hedging approaches. So that's what we have delta neutral hedge. We also had delta gamma neutral hedge. Because we say that delta also we have to make it zero, or we have to make delta gamma also. Can be achieved by buying enough put option to offset the gain or loss in the underlying. This is another approach. A delta neutral hedge can be achieved by buying enough put options to offset the gain or loss. So this is like a portfolio approach, right? Because it's a portfolio hedging approach. What you're saying here is that you have a portfolio of, let's say, 10 crore. You kind of hedge it by buying your index put option, so that if the market crashes, the index put option gains. So you remember a strategy, there was a strategy which I taught you, protective put strategy. Protective put strategy was similar. Now, protective put was what? Protective put was this only. Remember, anybody remembers what is the protective put strategy? You are long on stock, but you're still going long on put option. Why you are going long on put option? Because your objective was that if there is a market crash, you make value, whatever you lose in portfolio, gain value in the put option, right? You remember protective put strategy? Protective put, right? Protective put I have taught, na? Protective put, right? That's the same approach it is taking. Protective put. Again, this chapter is very intricately, mixed with trading strategies. If you don't know trading strategies much, you will be confused here for long, right? So just remember that. So the idea here is the relationship value of puts is equal to your minus value of put here is equal to negative negative delta value of long stock position. Basically, it's a way to calculate. Just remember it. Not too much of maths here. Just remember this part, that you are saying in a way that how do I find out? How do I find out how many puts to purchase, number of puts to purchase? I purchase one by call delta minus one put option to protect against long share of stock. Remember, this sometimes comes in exam, right? So just as important to call. See here, for 60,000 share of ABC long and a call option delta so and so, the put option delta. I told you put option delta is what? If call option delta is 0.60, right? Put option delta is opposite, 0.60 minus 1 is minus 0.40. Now, to hedge, the investor needs to purchase what? So, same thing. You are hedging now 60,000. Your objective is to hedge 60,000, right? 60,000 shares of ABC stock, right? With a put option delta. Please understand when I say put option delta, right? Put option delta, if I say put option delta, if I am taking your okay, if this is 60,000 shares, right? This is positive. Put option I have to take. Put is as such negative. Put is negative. Now I put is negative. So should I go long put or should I go short put, guys? Methodically, if you remember protective put, you understand long put. Even if you don't understand protective put, you should understand that my objective is to make it zero. My objective make it zero. So I want to have negative only, right? Here I want a negative value. If you want a negative value, I want long put. Because long will be positive. Put is negative. Put is negative. Long is positive. Negative and positive makes it negative, right? So I need negative value. So 60,000 minus 0.4 delta into n, right, is equal to 0, right? So I take it other side, n is equal to 60,000 divided by 0.4. Forget about this negative sign. That's a different approach. I don't want to go there. Follow my approach. Very, very simple. I hope you are understanding. This question is what? Same logic. Earlier, what I was doing is, I'm not able to write it too much here, but I can help you to just analyze it much better in, one note. Let me write it there, right? See, the approach is very simple, guys. Approach is very simple. Don't make it too difficult, right? See, first of all, there are only two strategies differently discussed in this chapter. One is your covered call. Covered call was long stock plus short call. Other is protective put. Protective put was long stock and long put. Okay. So there are only two strategies discussed. First of all, that makes it very, very easy. The two strategies. Now, if somebody asks me, sir, what is the delta neutral approach? Please understand, delta neutral approach means if I say delta neutral, simple idea is I have to make delta zero. This question, let's say I solve it both ways. Let's hedge it by calls. Let's hedge by calls. I'm solving two examples simultaneously to make you understand. Let's say I want to hedge by calls. My portfolio is what, guys? My portfolio is 60,000 shares, right? 60,000 shares. So 60,000 shares. Delta of a share position. Delta of a share is what, guys? What's the delta of a share? This number of shares. What's the delta of shares? What's the delta of share, guys? You know that, right? What's the delta of shares? Come on, guys. Delta of share is 1. Everybody knows the delta of share is 1. Yes or no? So my existing position is 60,000. Existing position is 60,000. What 60,000 delta? My existing position is 60,000 delta. I want to do delta neutral. Delta neutral, what do I do in delta neutral, guys? Tell me. What do I have to achieve? Delta neutral, what do I have to achieve? What do I have to make? Delta zero, na? Yes or no? Everybody agrees, yes or no?
Yes.
Right? 60,000 plus something makes it zero. So it makes it very clear. See, this is positive. I have to add some, I need a negative number here. My point is I need a negative number here. Right? So how do I get a negative number here? Negative number here, either you remember these things, that there are two options. Covered call, protected put. Covered call delta is what? Covered call delta, you take it. If I have to take short call, right? Short call by delta. Short is what? Short is negative or positive delta? Only short. Short is negative or positive? Short is negative. Call is positive. This makes it negative. So either I take short call. That's one option. What about long put delta? Long is positive. Put is what? Negative. This makes it negative. So if I have to get negative number, there are only two options I have. Either I go short call, either go long put. I'm doing by your short call. So 60,000 short call, right? So short call means sell call, right? So N, let's say N into your call option delta is equal to, or whatever, the sign has to be negative, right? Sign has to be negative because I want a negative number. Sign has to be negative. I want a negative number minus N. So 60,000.6 into N. N makes it 100,000. So that's a one way. That's a one way to get your 100,000 call option. Now, if you want to hedge it by long put, then also you can do it. Right? Then also it's easy. Same logic. You have long stock 60,000, right? I want long put, which is again negative. So I put in negative value. Only thing is N here, right? N, let's say this is our N1. I put it N2. N2 into your 0.4 delta of put, right? So I put it, take it other side. So 60,000 divided by 0.4, I get 150,000 put option. So you see, you can hedge your portfolio by call option also, by put option also, depending on the delta, right? And your two options are very simple. Either you are doing by your long call, either you're doing by long put, either you're doing by short call. Both are giving me negative value. That's it, guys. That's a very simple thing. Just know how to calculate put option delta. This is sometimes troubles people. Put option delta, if you have to calculate, right? So I told you very simply, that's why it was taught to you. Put option delta, if you go back when we studied in the thing, that put option delta is what? Call option delta was ND1. Put option delta was what? ND1 minus 1. Right? Put option delta came out as minus 0.4. Right? So just remember it, right? So there are a lot of dots here and there you have to join, right? You have to join a lot of dots. But again, this is like a chapter which is not using concept only of this chapter, but this is using concept of previous few chapters also. That's why there is a confusion here. That's why I'm telling you that you have to, in a way, go back and revise your trading strategies, etc. Very, very important. So go back, understand it, figure it out. It's not difficult at all, right? If you practice it, forward position delta is one, future position exponential RT, right? Remember this, all these things I have written in lot of detail, right? These things uh, are done with a lot of effort and kept it here. I don't delete it because when the first time I took classes, I made all these things. So these were good things which I made. So this will really help you. Only thing is you have to go back and sit with it and try to understand it with the previous topics, right? So that's the idea. Okay. Yeah. So these notes are already there. Now these notes are already on the available on the uh, you know portal, right? These are not deleted, right? These are, I've added these everywhere, right? These are available on the portal. Okay, that's the thing. Okay, yesterday once also. Yesterday there was nothing, right? Yesterday one page was there. Uh, Yesterday there was nothing. I think I deleted that. Today morning only I deleted because I think there was simple. Yesterday one I think I don't have now. Uh, I was doing something and deleted, but this one I can share. Okay. You can watch the yesterday there was nothing there, just how to write it down. That was the thing. S minus X kind of thing. Okay. So that completes our this part. Now we are getting into the third part of the module, right? So this is a long chapter, right? 1.5 hours is finished, but we are still not done with the chapter. We're left with 10-15 minutes more or more than that. So now we have other theta, gamma, relationship between delta, theta, and gamma, Vega, rho, delta, gamma, Vega, hedging, portfolio insurance, right? So a few things we have here. Okay, so that's what we have to do. Okay, so yeah, it's very hot here, guys. Summers, right? So now I have a good news also. I have a bad news also, right? Here when I'm teaching it. Good news is that generally, generally, if you ask me in this chapter, question generally comes from delta neutral hedging. So the most important Greek, at least from the FRM perspective or from the portfolio hedging perspective, also is delta, right? So the good news here is that if you study first two modules, most probably the question will come from there. The bad news here is that last year there was a question which came from one of these things, and they asked actually this formula. They asked actually this formula, and they asked like these formulas and told that find out the value of theta of your call, theta output by this formula. Now, believe me, guys, whenever I teach students, I tell that you cannot remember everything, right? So if I am a student practicing for the exam, I will not remember this formula, right? I am not, see, for 1 mark, doing so much of effort, I don't, that's worth it, right? There's so many formulas already. Point is that theta has a formula, right? Point is if you go ahead, gamma has a formula, right? Gamma has a formula, right? If you go ahead, your rho has a formula, right? Your rho has a, let's leave that, but three questions. Rho has a formula, right? Rho has a formula, right? Okay, this is the formula between delta, gamma, and right. So there are so many formulas ahead, so many formulas ahead. Right now, I know this is very tough, and this comes in exam. See, Vega also has a formula. Vega also has a formula, and your rho also has a formula, right? So I am giving you a very controversial advice now. Controversial advice is, and I give you advice as if I am a student, right? I don't give you advice which is bad advice. And I give you advice what I will do if I am a student and giving this exam, right? See, if I am a student giving this exam, I know that there are so many formulas to remember, right? And it's challenging, right? As a student, it's challenging, right? When you reach to my level or my place, then things are different a little bit. But when a student you are giving exam, you're already troubled, right? You have so many things to manage, right? So if I am as a student thinking about passing this exam, I will not remember this, right? I'll take a chance. I'll take a chance. Again, it's a controversial advice. You might miss out one question because of me, but I will not remember this formula. No, I am playing a probability game, right? Which I played in your interest rate swap also, where I did not teach you the currency swap from FRA perspective, right? So I told you very importantly that don't read currency swap from FRA perspective. Similarly, here also I'm telling you, I'll not remember this formula. I will remember this formula. This formula I'll remember. So I will remember delta formula. I will remember gamma formula. Why I'll remember delta and gamma formula? Because delta and gamma are more important, right? Other than delta and gamma, I will remember one more formula. I will remember this formula also. This formula, this first formula only. Next formula comes out from the first formula only. So this formula also I will remember. So these three formulas I'll remember. Otherwise, I will not remember this formula, right? No need to remember this formula, right? I will also not remember this formula. I'll not waste my time. If it comes in exam, I'm happy to leave one question, right? See, you cannot score 100% marks, right? Whatever you do. So I will leave this formula also. I will leave this formula also. If you are a student who has a very good memory, right? You want to remember everything, do it. I'm not stopping you. But I play a little bit differently. I take chances a little bit because I know that whatever you remember it very well, and focus on important things, right? So if you see this whole this finished chapter is finished. So what I'm trying to put across, if I go back, that I will, like, if we start this chapter from the starting, right? So if you see the first two parts are more important. These two parts are more important because here you are talking about delta hedging, naked, covered options, etc. And then this gamma is very important. And then there is a formula which is linking delta, gamma, and theta. That is very important. So I will focus on these three things, right? First two modules, gamma, and then there is a formula which is linking delta, gamma, and theta. There is a formula delta, gamma. Now this pen is hanging here because this has become very heavy presentation. Delta, gamma, theta. That's the formula. I'll focus there. Other than that, I'll not focus on theta, vega, and rho. Right? I'm taking a chance, right? But that's what there's so much to remember here, right? There's so much, and this is one chapter only, right? This one chapter only. I have to remember not only covered call, protective put. I have to remember stop loss strategy. I have to also remember your forward delta, future delta, hedge maintaining, right? Call option value of delta 0 to 1, -1 to 0, right? ND1 for Black-Scholes Merton. I have to remember these things also, that ITM, the values are -1, ATM maximum, where it is maximum, where it is in ITM, where it is maximum, ATM, where it is maximum, OTM, what are the implication I have to remember, right? Again, I have to, yeah, this is what I have to remember. Then delta neutral hedging, how we have to solve the question. Then this part I have to remember. Then this part I have to remember. Delta of call, ND1, ND1 minus 1, delta of put. That helped me solve that, how to hedge with put options, right? I have to solve with that, right? So what I'm trying to say is there is obviously so much to remember. Forward delta I have to remember, future delta I have to remember. So I will pick my battles, right? I'll pick my battles. I know this is a risky strategy. I might miss out on one question, but that's okay, right? You take chances, right? So this numerical I understand. Here I'll try to understand everything in first two things. But from here, when I go, I will be selective now, right? I'll be selective that, see, already there is so much to remember. It's not that this chapter will have 10 questions, right? Maximum question from this chapter will be 3. There is no chapter which can have more than 3 questions, right? The total questions are 100 only, right? So this chapter can maximum 3 questions. If at all they ask 3 questions also, one question will be on delta, I'm pretty sure. One question will be on maybe properties of Greece, delta, gamma, theta, where it is highest, etc. So 2 questions I can solve. One question, if I miss it also, that's fine, right? That's totally fine. So again, theta is what? Measure an option sensitivity to decrease in time, also known as time decay. For a call option, it is change in option price or change in time. Time varies, theta varies with change in stock price and time passes. Characteristics I have studied. Characteristic is same as what I have given you. These characteristics are same what I have given you in that table. The table I have shown you now, these characteristics. These characteristics are right. These implication are the characteristics. These implication are the characteristics. I have written only one most important characteristic which can come in exam. The most important characteristics I have written here. So please remember this one characteristics at least. If you want to go learn many characteristics which are given here, but at least one I have given which is the most important, right? One characteristics here is generally affects your put and call option. Similarly, most decreasing value as time passes. Most pronounced when the ATM, when the values at the money. This is I have given. This is my table. This is I given in the table. Usually negative, indicating option value decreases closer to expiry. Increase in absolute value expiry improves approaches. Possible for in the money European put option to have positive theta. Remember this line also. This line also comes in exam. Theta can be positive for in the money European option, right? Sometimes. Very rarely, but sometimes. Don't worry about this diagram. This is just shown how theta moves as a function of call price and how theta moves as a function until expiry. You want to learn it, you learn it, but it's quite complex, right? This chapter is very heavy, right? The last chapter. Similarly, gamma, this I'll remember, guys. Gamma represent the expected change in the delta of an option. This is basically change in the delta. It is a second order derivative. That's why it said del square C by del S square. This is the only one which has square derivative. It is for $1 change in stock price. Delta will change by the gamma value. Relationship with the stock price. Gamma is largest when the option is at the money. This is what I have given in my table, guys. This is the line I have given in table because this is asked mostly in exam. Remember this table, right? So deep in the money or out of money options have little sensitivity to gamma. Remember this line. When gamma is large, delta changes rapidly. When small, delta changes slowly. Delta neutral position hedge against small stock price changes, while gamma helps hedge against large changes. It is desirable to create both delta neutral and gamma neutral position. This is what I told you, that when you go to advanced level things, you do delta gamma neutral, right? You do delta neutral also, gamma neutral also, to protect against both small changes also, large stock price changes also. Now let's look at gamma neutral. This is another set of numerical gamma neutral level. So this is your gamma neutral thing. Now we are saying a thing is a delta neutral position. So we are saying stock is already delta neutral. It has a gamma of minus 3200. An existing option with a delta of 0.5 exhibits a gamma of 1.5. Which of the following will generate a gamma neutral position for the existing portfolio? Now, I'll show you the answer for this because this is not a question which can be solved very easily, right? So, see, you are already delta neutral. Now, you want to create a gamma neutral. See, when you try to create a gamma neutral, please understand, the delta neutral will become not delta neutral. A manager must add the appropriate number of options that equal the existing portfolio. See, in this case, the existing gamma position of minus 320. An available option exhibits a gamma of 0.15, 1.5. So if 1.5 means you already have 1.55. So what do you multiply? Basically, your objective is to make gamma neutral. Now you are existing is minus 3200. Ultimately, you have to make it what? Minus 3200 plus something. is equal to 0. You have to make gamma also neutral. Now, you understand n into 1.5. You need to find n. One gamma position is 1.5. So it is same thing. Minus 3200 n into 1.5. You solve it, you get the n value. N value came out as 2133 option. So this is one of the simplest of examples. But the next numerical will be more tricky, right? Because this is very simple, guys. You have to make simply 0 minus 3200 plus something positive is equal to 0. So one option had 1.5, n into 1.5, you found n, right? N was 2133. Now, the same question, which of the following action would have to be taken to restore a delta neutral? Now, the problem is when you kind of, what did you do? When you bought 2133 option, what happened to the delta? Now, when you tried to make gamma neutral, it became delta not neutral, right? So now see this, when you bought the gamma neutral hedge, when you bought 2133 option, then that changed the delta by what? Delta was 0.53, right? So 2133 option, when you bought, it increased the delta by 0.5 because delta was 0.5. Gamma was 1.5, delta was 0.5. So gamma increased by 1, so delta changes by 1.67. So please understand, when you tried to make gamma neutral, the delta became unneutral. Delta changed by multiplied by 2.33 you bought. So delta became 0.1067. So then you have to again make delta neutral. So please understand how it works. First you make delta neutral, right? Then you make gamma neutral. When you are making gamma neutral, it becomes again delta not neutral, right? So not neutral, right? And then again you have to make delta neutral. So it's a 4-step process. Delta neutral, first you make, then you make gamma neutral. When you make gamma neutral, it becomes delta not neutral. Then you have to make again delta neutral. But luckily, in this process, gamma does not change because gamma is a second order derivative, right? So this is the way it moves. Delta neutral, then gamma neutral. So first thing was given delta neutral. When you try to make gamma neutral, it became delta not neutral because delta changed to this. Now you have to sell approximately this share, then become delta neutral, and now this is delta neutral and gamma neutral both. Okay, so please understand how this works. Okay, please understand. Okay, it's a little complex. I don't think this will come in exam. Very rarely it comes, but in portfolio management, we always follow this. First, you make it delta neutral. Then you make it gamma neutral. When you make it gamma neutral, please understand delta will change. Delta will become not neutral. So go back and change delta again to neutral. Right? So same thing. You move this thing, then this thing. Then you move this thing changes, then make this thing again, right? Delta neutral, gamma neutral, delta not neutral becomes, then make it delta neutral, gamma neutral both. Right? So again, a complex kind of process, right? Very weird kind of process, but yes, how it works. Right? This is next question. An option with a strike price of 12, current stock price 12, that has 1 week until expiry, is likely to have a gamma of an option seller. This is the properties question. If you don't know the property, you cannot solve it. Strike price and current stock price. Strike price and current stock price, this is in the money, at the money, or OTM. What is it? Strike price and stock price are same. What is it, guys?
ATM.
ATM, I told you, ATM, what happens? Right? ATM gamma is positive or negative, right? If you don't know the property, you can't solve it. This is what I was telling you. You have to remember the properties, right? You have to remember gamma is most negative for at the money option near expiry for an option seller, an option with strike price at the money, right? So that's why I told you there are 3 which are bigger at the money, 2 which are bigger in the money. This is the properties question. This kind of question comes in exam. Then we have relationship between delta, theta, and gamma. Remember this relationship, guys. This relationship, only thing is the next formula, don't need to remember. For a delta neutral portfolio, delta is 0, so this becomes 0. But remember this formula. What is it? This is R. What is this? One is theta. See what is happening. this is portfolio value. This don't worry about this sign. This is portfolio value. This is portfolio. So R into portfolio value is equal to your theta plus your RS delta, right? Plus point 0.5, right? 0.5, your sigma square is it hanging now? 0.5 sigma square gamma. This is gamma. Last word is gamma, guys. This is gamma. This is delta. This is theta. This is portfolio value, right? No numerical will come on this. Just have the idea. The left side of equation is the dollar risk-free return on the option, right? So dollar risk-free return on the option, basically the portfolio. Assuming the risk-free rate is small, the demonstration the large positive value of theta gamma tends to be large and negative, and vice versa, which explains the common practice of using theta as a proxy for gamma. Anyways, don't go into that. This will never come in exam. This is too difficult a concept, right? Just have an idea. Then this is Vega. Don't remember the formula. If it comes, leave it. Understand the property. Measure the sensitivity or option price to changes in volatility of the underlying stock. Vega is leave it. Vega of 8 indicates that for a percent increase in volatility, the option price will change by 0.08. Definition. For a given maturity exercise price risk rate, the Vega of call is equal to the Vega of put. So remember that Vega of call equal to Vega of put is the same. Options are most sensitive to volatility when they are at the money, which I told you. Deep out of money or deep in the money options are little sensitivity to volatility. Remember this properties. Vega for European call and puts on non-dividend say calculate this way. Don't remember the formula. If you can do it, but otherwise I'll not remember. I don't think so much is will be asked. If it asks, leaving one question is never a bad option. See, FRM is all about whatever you know deeply, right? If you know something deeply, you will get marks. Shallow things will never get you marks, right? So if you want to learn it deeply. Otherwise, skip it, right? That's the don't learn it half-heartedly. Rho, measure option sensitivity to change in risk-free rate. Equity options are less sensitive to interest rate changes compared to other variables like volatility stock price. Large rate changes are only small effect on equity option price. Rho is much more important risk factor for fixed income derivatives. In the money calls and puts are more sensitive to rate changes than out of money. Remember the property. Increased rate leads to large increase for in the money call prices, large increase for in the money put prices. For European option and non-dividend paying stock, Rho is measured as this, right? Remember that, right? Formula, you can skip that, right? Not so important. So this is what is the question. Which of the following statement about Greeks is true? Rho for fixed income is small. No, rho for fixed income is big, right? Call option delta ranges from -1 to 1. No, 0 to 1. This is also wrong. Vega of 10 suggests 1 change and option price. This seems right. Theta is most negative for out of money, no, at the money, no. So it's easy, right? If you remember the property, it's easy, right? But you have to go back and remember the property, right? C is the answer, right? Yeah, C. Okay. Then delta, gamma, vega, simple point which is given. If you have to find portfolio delta, it's a weighted average. Don't worry, it's a weighted average of delta of each position in the portfolio, right? Portfolio vega, gamma, it's also weighted sum of vega and gamma. Nothing much to worry, right? Practice question, again, weighted average of thing. Weighing of 20% of 0.75, 35% 0.45, 75% this. Just multiply and add, right? 0.20 into 0.75, 0.35 into 0.45, 0.45 into 0.60. Just multiply and add, right? 0.58. Hedging activities in finance. Hedging is important. Hedging activities in finance, right? Expense of maintaining Greek neutral position. A significant challenge for option trader is the cost of trying to maintain position that are neutral to all Greeks. Not easy, guys. You cannot make all Greeks neutral, right? If you try to make all Greeks neutral, the cost will be so high, trade will become inefficient. So you have to choose, right? Normally we choose delta gamma. Only delta gamma we choose. But again, depending on algorithmic trading strategy and the amount you have, decide. Difficulty with gamma and vega, while delta neutral position are achievable, it's harder to find security the regional price that can mitigate the negative effects of gamma and vega. Gamma we try, vega we never try also. Trading limiters, trader face limits from Greek exposure, delta limits, gamma limits, vega limits. That's what. Common practice of financial institution, large financial institution typically adjust on delta neutral position, then monitor the experience to other Greeks. Offsetting valuation, institutions selling options often have negative gamma and vega, which worsen over time if the option stays near the expiry. That's why if you are ATM and near the expiry, you're always worried when you're option seller because one massive movement, gamma will shift and you will be in losses. When options are initially sold at the money, the sensitivity to gamma and Vega is highest. As time passes, options tend to move in or out of the money, reducing the impact of gamma and Vega. Right? Additional Greeks, trader may also calculate charm, which I told you. I showed you second order Greek, Vana second order Greek, Voma second order Greek. So this is also I showed you that there are many other Greeks in the image. You can go, but never come in exam. Portfolio insurance, this is protective put, guys. Portfolio insurance is a protective put strategy, which I told you. How do you insure portfolio? The combination of underlying instrument and either cash or a derivative will establish a core value of the portfolio, or still lying for upside potential. There's a comparison with delta hedging. Delta hedging involves combining an initial investment with opposite kind of thing. Either you sell a short call. Portfolio insurance involves hedging a long position using a long put option. Protective put, guys. This is exactly protective put, PP. Right? Don't forget protective put. This is again protective put, long put option you are using. So buying put option, simplest way is to buy put option on the underlying portfolio. Loss in the portfolio can be offset by gains or long put option. Synthetic put option is you create something synthetically. If direct put options are unavailable or impractical, synthetic put option can be created using index future contract. You can sell index futures. That is like put option only. Advantage of synthetic creation is lower trading cost or relatively higher levels of liquidity. Simple things. Just remember theory. Practice question now we have. Portfolio insurance payoff would not involve which of the following? Selling call option in the portfolio 1 by delta. Selling call option portfolio 1 by delta? Okay. Would not involve. Let's keep it for some time. I'm just confused. Buying put options 1-to-1 related to underlying. That makes sense. The question is would not, right? Buying and selling the underlying in the proportion of delta of the put. Buying and selling underlying. Buying and selling futures in the proportion of delta of a put. Delta of a put, buying and selling the underlying in the buying and selling the underlying in the proportion of a delta put, buying and selling futures. Confusing, guys, right? Portfolio insurance would not involve the following. Buying put option is 1-to-1 related to underlying. That's okay. Buying and selling. Selling call option, the portfolio 1 by delta. That's delta neutral hedging, right? That's not portfolio insurance. A is the answer, right? Tricky. I forgot, right? What was the A is the answer? Yeah, A is the answer, right? Fine. Okay, got it. See, guys, I don't remember the answers, right? I solved with you guys. Maybe I solved it 6 months back, but I was not remembering the answer. Yeah, finally, okay. I was also confused in few things here. It was a tricky question, not easy. So idea here was see this strategy, selling call options, right? This is this part of delta neutral hedging, right? In the proportion 1 by delta. So this is delta neutral. This is not portfolio insurance, right? Portfolio insurance is insuring the portfolio, right? So you are buying and selling underlying in the delta of a put, right? That is insurance. Buying and selling futures and underlying are same in the delta of a put. That's also insurance, right? And buying put option, that is also insurance, right? So these three are insurance strategies. Just remember it, right? You don't need to go how this works. This is protective put, but these also are used. Right? You do it, right? What you do is you buy certain stocks, like a certain position you are holding it, and you sell the underlying in the proportional delta put, right? So this is also insurance strategy. These two are also insurance strategies, and you do it by delta of a put you calculate. So these are insurance strategies, last three, right? These three are insurance strategies. This one is your delta neutral strategy. The question was asking which of the following is not a insurance strategy. Selling call options is delta neutral strategy. Right? Just remember it. Don't go deep. Okay. So that's it, guys. That completes our chapter. But again, this is a difficult chapter. Right? It's a very difficult chapter. Even if you are very good in derivatives, even if you know trading strategies well, then also it's difficult. Right? It's not an easy chapter. Now, See, when they are very difficult chapter, you have to be a little smart here. I told you max question from a chapter is 3. If there are 3 questions coming from this chapter, I can tell you very clearly that one question will be on properties. One question will be on either delta neutral hedging, delta gamma neutral hedging, or gamma neutral hedging, or delta gamma theta formula, right? Or delta something, right? So one will be in properties, one will be delta. So out of 3 questions, 2 questions you can easily get right. So what I'm trying to say is that, do you want to spend 20 hours or 10 hours fighting for one question? Or do you want to be smart enough that, so it is, my point here is that total questions coming here are 3. If you want to get 2 out of 3, everybody can get 2 out of 3 in this chapter if they study for maybe 3 hours. After my class, if you go and study for 2-3 hours, everybody can get 2 out of 3 right. To get 3 out of 3 right, it's an effort of maybe 6 hours, 6-7 hours. Now question comes is, for one question you want to put 3 hours more or not? That's the question you have to answer for yourself. Right? Do you want to do that much effort for one question or not? I will not do it, right? Because there are other chapters also, and there is no guarantee also that if I put 3-4 more hours, will I get this one question right or not? Because let's say I studied everything and I miss out one line, and the question comes from that one line. So I miss that out, right? So I will be a smart student here. I know that there are 3 questions which are coming from this chapter, right? One question will come from your something called delta neutral hedging. So these all initial concepts, which are logical concepts. I'll try to understand, nothing much to mug up also. So I'll try to understand delta, ND1, these properties, etc. If I understand this property, delta 1, and these properties which I've highlighted, main properties I've highlighted, calculations, etc. If I focus quite well here till first 2 modules, I get 2 questions right easily, right? If I get 2 questions right, I'm pretty happy. The last part here I'll also be a little smart that I will not waste time in this long formula. If they are coming, I'll leave the question. I'll focus more on properties, remembering properties, right? I'll focus on this gamma neutral thing, understand bit of things this might come. And again, properties of Vega, properties of rho, right? I'll try to understand, and this also quickly read. Here also quickly read. Here also remember 2-3 things, right? Thing, right? So my point is, be smart student, right? Be smart student. Sometimes, like I told you, right? I never teach that your forward rate agreement method, right? FRA method for your FX swap. I never teach also in class, right? Because chances of that coming in exam is less than 1%. If it comes, consider yourself unlucky and move ahead, right? Similar thing here is, if very difficult thing comes, consider yourself unlucky and move ahead, right? You don't have to score 100 out of 100, right? Objective is to score 70 out of 100, right? So we can easily give away few questions by focusing more on other chapters, right? Because there are a lot of syllabus we have, right? So a smart student will always focus on what is more likely to come in exam. It is more important that you score 70-80% in every chapter rather than one chapter 100%, another chapter 0%, right? So try to become a master of 70-80% major things in every chapter. That will make you pass. Objective is to pass. Objective is not to kind of score 100 out of 100. Nobody cares how 100 out of 100. Pass is a pass, right? How much marks I got, nobody cares. I passed it, it's finished, right? So keep that in mind. Every chapter which you study, get major concepts aligned. Understand major concepts well. If you have mastered major concepts well, you are totally fine, right? You don't need to worry too much, right? So that's what this chapter is, right? So be a smart student. Don't waste your time here and there, right? I'm telling you very clearly. I've seen a lot of students, sir, it is very difficult. I'm not able to remember this small formula. Leave it. I'm just saying it, right? Leave, bro. I'll not remember it. I am a student. I'm giving you same advice which I'll follow. I'll not remember this formula, right? Why should I remember? If it comes, I'll leave it, right? So I'll not remember because it's too much to remember, right? I'll not remember, right? There's as such Black-Scholes formula. Last chapter there was too much to remember. Here also too much to remember. I will only remember selective formulas which has high probability of coming, right? Rather than remembering every formula, right? Gamma I'll remember because gamma is very popular. This I'll remember, right? Otherwise, I'll not remember any of that. I'll not remember these formula, right? So I've given very clearly, and I focus more on delta. Delta, gamma, that is more thing. Delta numericals also focus because delta is one thing which FRM part 1 asks you a lot, right? So delta I will master. Properties also, I've given you 5 properties, top properties which are asked in exam. ATM option, what happens, maximum value where, right? Everything I have given here, right? So if you remember only these 5 lines, quite a property questions can also be solved, right? And if you remember only that thing which I made, that where it is highest, right? If you remember this part also, at ATM, Vega, Theta, and Gamma is highest. ITM, rho, and delta is highest, right? So if you remember these things, you'll be able to do it, right? So that's it, guys. That's it for this chapter. Go back, revise it, be a smart student, right? Focus on revising, focus on practicing question as much as possible, right? As many questions you focus, and don't waste your time on unnecessary things, right? There are a lot many other chapters to focus on. Okay, that's it, guys. We'll stop here, and I'll see you next week. Okay, thank you.